Good afternoon, everyone, and thank you very much for joining us this afternoon at the first of the 4 series of the Not-for-Profit Balance Sheet with Professor David Gilchrist. Some of you may know Professor David already because we've worked with him on a few other occasions and we've only had good feedback, so we're very, very pleased that he's with us again this afternoon. He's zooming in from Perth, so he's 10 o'clock in the morning, whereas we are 2 o'clock in the afternoon. And David has a career spanning over 30 years and has held a number of senior roles in the not-for-profit, so he definitely knows what he's talking about. He's currently a professor at the UWA Business School in Australia, and he's also done a lot of research. He has presented a similar series in Australia, and we're very confident that you will find it very rewarding. Just to confirm that we are recording this session, and if you'd like to receive the recording, then by all means let me know, and we'll also send out the slides to everyone who registered after the sessions. I'm handing over to David now.
Thank you very much, Natalie, and thanks for the opportunity to be here. I'm very pleased to report that I've had my first coffee, and I hope everyone's had some lunch or something to have sustenance for the next hour or so, which is great. Before I start, I'd like to acknowledge the Whadjuk people of the Noongar Nation, the First Nations people who have shepherded the land from which I'm presenting for thousands of years, but to also acknowledge the elders, past, present and emerging, of all of the First Nations people around Australia and New Zealand and elsewhere where people might be attending this conference. I wanted to talk today, obviously, in the context of a series looking at the not-for-profit balance sheet. And I guess, first and foremost, I'd like to touch base on a couple of points. The first one is the discussion today is really to try and highlight the key issues and elements related to the balance sheet and what volunteer directors and others of non-accounting persuasion might consider asking questions about when they're looking at the balance sheet. And I guess in that context, we're really considering the balance sheet with regard to the balance sheet management tool that was released by myself and my colleague Dane Etheridge from Curtin University last year, and which we think applies equally in Australia, in New Zealand as it does in Australia and elsewhere around the world. So accounting, and I guess my perspective from reporting and accounting in this context is it's really jurisdictionally agnostic. I'm not going to be talking about regulations or what you might need to do to fulfill your regulatory obligations in New Zealand or anywhere else, but rather what accounting means in the context of balance sheet and what kinds of things you might consider to be important. To that extent then, just so that you're aware, the not-for-profit balance sheet, which is the tool that was developed, is available for free from my website, and this slide deck has my contact details and our website on the end of it as well. So you're very welcome to download that. And as I say, I think that is really useful regardless of the jurisdiction you operate from. I'd also like to acknowledge the Commonwealth Bank who funded the development of that resource because, of course, without their funding, it makes it very difficult for us to do this kind of industry-specific outcomes research that we want to do. My agenda today then is to really spend probably 40 or 45 minutes talking to these points that are based around making people familiar with the tool and what it can do, but also the balance sheet and its importance. And then to have, say, 10 minutes or 15 minutes of question time. And I'm really happy to take questions as we go through if that's critical, but perhaps those people who want to ask questions might include them in the chat room. And then perhaps, Natalie, if you're able to just keep an eye on those and you might ask the questions afterwards to make sure we're not doubling up and that we're capturing as many questions as we can.
Absolutely. Sounds like a great idea.
So to that extent, the resource sounds like a plan. We've got a plan. Great. So the resource itself, as you can see, is really divided up into 4 sections, and I'll speak to those sections as I go through my presentation today and hopefully highlight and illuminate for people some key issues that I think relate to both risk and governance prospects around the balance sheet and its use. But essentially speaking, the sections are, section 1 looks at the balance sheet itself and basically describes what it is. I guess section 2, we're interested in cash, and cash is king, as I'll reiterate shortly. Without cash, the golden rules of business apply. And the golden rules of business, for those who aren't in the know, the golden rule of business is the person with the gold makes the rules. And so at the end of the day, being able to have cash and cash reserves and so on is a critical part of the governance structure of any organisation, including not-for-profits and charities. And then asset replacement is a key issue that I often find when I talk to people in the sector who struggle with when to identify when when assets should be replaced, but perhaps more importantly, around things like valuation and understanding whether or not you have more in value of assets over liabilities, which of course is fundamental to solvency and ongoing sustainability. And then I'll have a bit of a chat about cash flow budgeting and financial planning, particularly as we go through the presentation. To that extent, there's a couple of rules, I guess, around the resource. The first and foremost, as you can expect, the resource doesn't provide advice. And indeed, my presentation today is very much of a general nature. I'm happy to answer questions, but without really coming to grips with your organisation and understanding it fully, I can't necessarily provide you with the best possible answer. And so it might be that we need to chat outside of the room, which is fine, or it might be that you get advice from your accountant, auditors, and so on. The audience for this resource is very much people who don't have an accounting background. So accountants generally should have an appreciation of these things and certainly an appreciation of how the balance sheet works. The audience for this tool and for this presentation is really those people who have skills in other areas other than accounting and who aren't illuminated in the mysterious ways of the accounting process and what happens there. To that extent, I think it's really important to appreciate, though, that it's critical, particularly for those charged with governance, that they understand these issues. And if not have the answers, they certainly need to be able to answer the questions. And one of the key things about the tool that I've been talking about is that it has a set of proposed questions for directors that they might ask of their organisation. And I think that's absolutely critical. A good director is someone who is able to ask questions and make sure they're the right questions to ask, I guess. The third element is that we look at accrual accounting and cash accounting in the context of the resource. And I'm happy to talk more about that in the discussion at the end of the session in questions. People might have comments and so on. But accrual accounting basically is the more complex area of accounting where we actually look at the legal position and performance of the organisation as opposed to the cash position and performance. And I can talk to that a little bit more, as I say, going on. But we do need to think about cash accounting, and cash is critical, of course, for the organisation to survive. But more importantly, having an understanding of how you account for assets and liabilities on the balance sheet in cash and accrual terms is absolutely critical. And again, I'm happy to talk through that and comment on that if people would like to ask about that when we get to the end of the session. And then finally, the resource, as I mentioned before, has really important focus questions that I think will help people to be able to understand what they should be asking, even if they don't necessarily have the answers or the appreciation of what the priorities might be. And then finally, in the tool, we've included a glossary to try and help people navigate accounting terms. And some of the terms that I speak to today, and I'll definitely highlight it when I get to those kinds of terms, might have a common definition, but they also have an accounting definition. For instance, one example of terms that we often use is the term user. That is the person that actually reads and makes decisions using the financial report that's provided. So when we use the term user today, I will be talking specifically about a person that needs that financial information and makes decisions based around that financial information, which is a accounting term rather than, if you like, the common term or common usage of that phrase. So the final point that I would say and reiterate is, of course, it's important to get advice, but one of the questions that often comes up when I talk to not-for-profit and charity volunteer directors particularly is whether or not it's appropriate for them to ask the CEO or to arrange for themselves to have paid advice provided to the board in relation to certainly the balance sheet in this instance, but all financial governance and operating elements. And of course, it is absolutely appropriate for those people who are charged with governance of an organisation to get the advice they need in order to be able to do the things they need to do. At the end of the day, it's not a good director, as I said before, is not someone that necessarily knows all. and is the be-all of everything, but rather a good director is someone that knows what questions to ask and I guess knows how to interrogate or looks to interrogate the answers that are provided in order to feel comfortable with the decisions that are being made and the direction of the organisation. So what the resource does, though, that I think is really important is that it describes the purpose, nature and governance of the balance sheet. It focuses on those untrained in accounting, as I mentioned before, and it provides those key focus questions that I talked about. Importantly, it's a starting point, and I think that goes together with my consideration of advice, but also making sure that it's specific to what you need. And my discussion today has got to be made specific to your needs rather than general. So to that extent, as I mentioned before, the structure of the resource is in 4 sections, and it tells us, I guess, a couple of things about the balance sheet, and particularly I want to start with the purpose of the balance sheet. In terms of the balance sheet, it constitutes one of 3 fundamental reports that organisations need to consider developing in order to maintain their financial governance. The first report is commonly understood and I think commonly recognised and perhaps more commonly used across most organisations, and that is the profit and loss report, or what might be termed the income statement, or it might be termed the operating statement. That is the report that gives us an idea of what income has come into the organisation and what expenses have gone out of the organisation. The other common report is the cash flow report, and that shows us not just what the accrual situation is, but rather where the cash has come from and where the cash is going. Our focus, though, is of course on the third report, which is the balance sheet of the organisation, or what is often termed the statement of financial position. And it's termed the statement of financial position because the balance sheet actually focuses on and gives us an understanding of what we might term the net wealth of the organisation. The net wealth means that it tells us what the assets of the organisation are and what the liabilities are. Now, I don't want to go into deep accounting theory about how you might define assets or liabilities. There is a common, I think, accepted definition of those 2 terms that essentially means that assets are those things that are either cash in themselves, so the cash that can be used and spent, applied to the operations and purpose of the organisation, or there are other situations that actually become cash for the organisation at some future point in time. So an asset is something that actually ultimately will become cash or is able to be applied to the purpose of the business or the organisation. In this case, we have current assets, which are usually cash and debtors, and non-current assets, which are usually things like buildings or motor vehicles. And I'll speak to that a little bit more as we go through the presentation. On the liability side, we have things like loans and bank overdrafts, which are akin to cash out or negative cash assets in relation to the organisation. But we also might have other liabilities that are associated with things like having to pay creditors or having obligations to employees, so long service leave, annual leave, or any of the other entitlements that employees might have. So what's a liability? A liability is a legal situation that will result in cash outflow at some point in time. So I guess this is a really important point to start off with. In terms of accrual accounting is about understanding exactly what our assets and exactly what our liabilities are at a particular point in time and being able to value those things. In terms of our assets and liabilities, we want to know what cash is there and what cash is owed, but we also want to know what, in the short and long term, assets and liabilities will either create cash or drain cash from the organisation. And so the balance sheet is not only representative of the net wealth of the organisation, it gives us an understanding too of what the prospects for the organisation are into the future. And I think this is a really important point for people sitting in on this presentation, to appreciate that the balance sheet doesn't just tell us what's going on today, but it tells us about sustainability into the future as well. So that timing of the balance sheet, particularly into current and non-current, is absolutely critical. Something is current if it's going to turn into cash or result in cash outflow in the next 12 months. Something is non-current if it's going to turn into cash or result in cash outflow at some point beyond that next 12 months. Sustainability is another aspect of that. And so what I've been talking about in terms of balancing off liabilities and assets, at the end of the day, we're really keen to ensure that we have a preponderance of assets over liabilities. In other words, we have more assets than liabilities. And I think most people in the room would recognise and appreciate the rationale for wanting that situation to occur. But we also want to see two fundamental rules met. One is that we have that preponderance of assets over liabilities, but more importantly, that current assets are greater than current liabilities, and as non-current assets are greater than non-current liabilities. So those assets that are going to be realised in the next 12 months need to be greater than the liabilities that are going to be realised in that period, and similarly for non-current assets and non-current liabilities. I think this chart shows generally what we're looking to be able to see in terms of information from the balance sheet in the short, mid and long term in the context of sustainability. So in the short term, we want to make sure that we're solvent, that we can pay our bills as and when they fall due. And I think most people are familiar with this concept. In the midterm, we need to be able to continue to provide services that meet the quantity, quality and timing required in accordance with the organisation's mission. And that is actually the definition of sustainability in the context of not-for-profits and charities. The corporation's survival is one thing, but actually being able to continue to pursue the purpose is an absolutely critical element in the context of sustainability. To be able to continue to provide services that meet the quantity, quality and timing required, you need to reinvest in the business. And that includes into the longer term where you need to be able to replace assets and invest for change. So being able to train staff and also re-engineer the organisation depending on government policy or other demand and other needs that you might impact from time to time. So therefore, sustainability means being solvent from a balance sheet perspective, but it also means being able to replace those assets and ensure that asset mix is appropriate to the services that you provide. I guess the other thing, just to make sure we're all on the same page, is to just have a very quick look at what the assets are and what kinds of categories of assets and liabilities we might consider in the context of the balance sheet. As you can see there, we're pretty much saying there's three types of assets and three types of liabilities that we're concerned to look at. I've already spoken about current assets, and those are assets that will become cash or are cash within the next 12 months. Non-current assets become cash after 12 months at some point in time, but also accounting estimates and are an absolutely critical element in relation to understanding the balance sheet. And I'll talk to those a little bit more shortly, but accounting estimates include our estimates of how much leave entitlements will be owed to people at this point in time and our estimates of depreciation. Depreciation is an incredibly important expense to consider in the context of the balance sheet management for your organisation and sustainability going forward. Depreciation is a representation of the consumption of your assets. If you don't cover depreciation in terms of profit for the organisation, then you won't be able to recover the value of the cost of those assets as it's invested in operating the organisation. I'll talk to that a little bit more, but I guess at this point what I want to say is that depreciation is not just an accounting entry that can be ignored. It's actually a critical element, cost element to an organisation that helps you to maintain your sustainability. I've also listed some examples of those assets and liabilities to give people an understanding of what those might look like. I won't go through them individually because of time constraints, but perhaps you should come back once you receive these slides and just have a look at these to make sure you understand what assets and liabilities are in the context of that timing. So what does sustainability look like? As I said before, more current assets than current liabilities is required, more non-current assets than non-current liabilities. But I guess the other thing that I just wanted to highlight and really emphasise is the fact that I think not-for-profits and charitable organisations should also be making a profit. The phrase not-for-profit relates to the fact that members can't make profit out of the organisation, not to the fact that the organisation shouldn't make profit. And this is still quite a common misunderstanding in terms of not-for-profits and charities, not just in Australia and New Zealand, but around the world. If you don't make profit, you are unable to build the balance sheet. If you're unable to build the balance sheet, you're unable to be sustainable in the medium and longer term. So in other words, you might have solvency today, but sustainability in the context of the balance sheet means being able to replace those assets and invest in the organisation in that longer term. You won't be able to do that unless you're making a profit as an organisation. Now, I know that's very easy to say, as compared to necessarily do, particularly in terms of those organisations that might be subject to significant proportions of government funding. But having an understanding of what the profit should be and what the profit is actually being made by the organisation is critical to be able to understand that profit gap. In other words, to be able to develop a financial plan, which I'll talk to shortly, needs you to understand what profit you need to be accruing to be sustainable in the short, medium and longer terms. So timing becomes really important in these issues, and particularly when we think about current assets and non-current assets and liabilities, we need to think about the timing of those assets and liabilities more directly and more specifically than just simply looking at them as short and long term. We also need to think about those non-cash items such as prepayments and income in advance. Prepayments are those elements where we've paid a bill that we haven't actually used the service or the good yet. And income in advance is particularly pertinent to most charities and not-for-profit organisations, for instance, that might be subject to government funding and receive that government funding before they provide a service. If we don't understand what that income in advance is, which is actually a liability technically in accounting terms, then we are potentially going to spend that money for things other than for the service that's required, and thereby put the organisation in some solvency risk at some future point in time. So it's really critical not only to understand those assets and liabilities in timing terms, but also to understand the nature of those assets and liabilities and what that information is giving you, particularly if you're a volunteer director, in order to understand how the organisation sits from a sustainability perspective. So what about those accounting estimates that I mentioned before? I suggested to you that those estimates need to be made, and they can be future focused, or they can be immediate. They relate to things like long service leave, annual leave and other leave entitlements that employees might have, and and are really critical to understand, not only in terms of what that liability is today, but also to understand from a board member's perspective what the likelihood is of paying out that liability at the current rates. So most people in the room would be familiar with the concept of annual leave accruing at the present rate, but it being adjusted over time according to the increased rates of pay that might be enjoyed by those employees over the longer term. That means that at the end of the day, if you're not managing your annual leave or other leave entitlements or other employee entitlements closely, you will be paying much more for those entitlements when they are realised at some future point in time. From a sustainability perspective, this has two key impacts. The first one is, of course, that you're paying more for an outgoing than you need to at this point in time. But secondly, your pricing structure or your funding only delivers income to cover off immediate costs. If those costs are then incurred in reality cash-wise at some future point in time, then there's going to be a cost to the organisation's balance sheet, because the organisation is going to have to foot the balance of that bill that is not provided by the funder. Depreciation, as I said before, is also a critical element. As I mentioned, depreciation is an estimate of the consumption of assets. If we don't understand depreciation, we don't really understand what the true value of that asset is. And so we have a problem in terms of estimating how much we have in assets in excess of liabilities. But also we have a problem in ensuring that we are making a profit, and particularly when we come to undertake things like tendering or pricing, if we don't understand the depreciation cost, then we're not actually developing a comprehensive price, and therefore we're mispricing our services and the goods that we're providing. That obviously has solvency issues going forward. Now, of course, assets and liabilities can be funded by philanthropists, by lottery systems and by other forms of donation to the organisation. But the principle remains the same, because we can't always rely on being able to replace assets through donative processes. But also, at the end of the day, we need to make sure that we're building into the cost of services the comprehensive elements, not just those elements that relate to, say, cash outgoings or employee entitlements. So if you don't identify those issues and particularly understand those issues, there is a risk in that the balance sheet will not disclose the full potential cost to the organisations going forward, and not building a profit has that impact as well, because you won't have the resources to be able to do it. You can do things like reporting leave balances to the board, But the leave balances themselves aren't as important as reporting not only the leave balances, but also when that leave is likely to be taken. So in other words, the leave, what we might term the leave experience. What is being taken out of that leave and how much is that leave actually costing the organisation when it's realised, as opposed to how much it cost when it was incurred. Of course, it's a big issue then if people are taking leave, or rather not taking leave and accruing significant leave entitlement. That has very significant cash implications for the organisation going forward. And one element there, of course, is the establishment of a leave policy and being able to communicate that leave policy not only to the board and have the board's imprimatur, but to all staff so that there's an expectation that leave is managed more closely. What are some of the other balance sheet issues? Well, when we think about depreciation and leave, one of the things that is highlighted there, and I'm trying to put across, is the fact that because depreciation is often considered to be simply an accounting issue and not really relevant to the solvency of the organisation, and because many organisations don't manage leave closely or appreciate the longitudinal impact of leave on the cash capacity of the organisation, valuation becomes a really critical issue in the balance sheet. Valuation is critical because if we don't value assets and liabilities correctly, we don't have an understanding of the net wealth. And if we don't have an understanding of the net wealth, we certainly don't have an understanding of the sustainability of the organisation going forward. The other thing about valuation is that directors generally, in terms of those charged with governance, are responsible for ensuring that valuation of assets and liabilities are undertaken appropriately. And so directors need to not only appreciate what the assets are, they need to appreciate what the value of those assets are and be comfortable with that valuation process. I'm sure people attending today would recognise and appreciate the great difficulty in valuing a lot of assets that are associated with not-for-profits and charities. Things like cathedrals or aged care facilities or other facilities that might have a very specific purpose can attract or be very difficult to value in the context of, say, property valuations and so on. The timing is also a critical issue. Not only do we break down the balance sheet into current and non-current, so within 12 months and in excess of 12 months, but we need to have a closer appreciation of the timing of realisation of assets and liabilities going forward in order to inform our financial plan, which I'll speak to in the last part of this discussion. Timing of that realisation is absolutely critical. And completeness. Are we completing? Have we got a balance sheet that actually identifies all of the assets and all of the liabilities of the organisation? If you're audited, this will be an issue that the auditor looks at. But importantly, the auditor is only concerned with material issues on your balance sheet, not with all issues. What does materiality mean? It means that if that item was erroneously recorded or if it was omitted and it was material, it would change how people interpret the balance sheet. At the end of the day, completeness is a critical element to be thinking about from a director's perspective. Of course, the risk is, in all of those situations, that the balance sheet is not really disclosing the full liabilities of the organisation because we might not appreciate the valuation, the timing, or have a complete record. Of course, the risk relates to assets as well, and we're looking at net wealth in this report, and therefore we need to have that appreciation. Most importantly, I think directors and those charged with governance, CEOs and others, won't be across sustainability issues if they're not across the detail in the balance sheet and how that balance sheet works. There's further issue, though, in terms of balance sheets for not-for-profit and charitable organisations, and that relates to the nature of non-current assets. In Australia and New Zealand and around the world, as we know, non-current assets can often be funded by philanthropists, lottery systems, government agencies, and so on. So the purchase of property, the purchase of motor vehicles, and so on, assets that are required to present a program or facilitate a program can be provided by those sources. Those sources, when they provide those assets, that asset meets the definition of asset in accounting terms. And I won't go into that, but it means that those assets can be legitimately put on the balance sheet. The key problem I want to highlight here, though, is that often philanthropists and others provide resources or provide the asset itself with a number of caveats over that asset. For instance, in Australia, it's quite often, quite common for lottery systems to provide buildings for charities and not-for-profit organisations, but with caveats over both the use of those buildings and the sale of those buildings for an extended period. In my hometown of Perth here in Western Australia, our lottery system requires people to hold those buildings and use them for the purpose intended for 10 years. If they can't hold them or use them for that purpose for 10 years, they must hand them to someone who can, so to another charity or not-for-profit organisation. In other words, when you read the balance sheet from an accounting perspective, you might be believing that there's more assets than liabilities, and therefore if there is a cash flow problem, you can realise those assets. But in reality, those assets can't be realised because they have those caveats of their use over them. They're called administered assets. And having an appreciation of what those administered assets are, in my experience, is very critical to appreciating the net wealth of the organisation and the risks it face from a sustainability perspective. But it's also really important to have an appreciation of those administered assets, because at the end of the day, often auditors don't really appreciate what the caveats might be over the use and realisation of those assets. And certainly readers of financial statements often don't appreciate that as well. So in other words, when you're developing a report for external use, being able to delineate between administered assets and controlled assets, which are those assets that you own and which you can use for your own purposes, is an absolutely critical element in being able to calculate solvency, and more particularly being able to communicate to directors and others that are involved in the organisation, other stakeholders, what the true solvency position of the organisation is should you have to realise all of your assets in response to your liabilities. So being able to differentiate non-current assets between administered and controlled assets, I think, is a really important and very relatively easy modification to the balance sheet structure to be able to delineate these two elements and to be able to get a better view of solvency for the organisation. The other thing that, though, can occur, and this has certainly occurred in my experience around Australia, is that those assets, if they're not delineated properly on the balance sheet, people can inadvertently misuse those assets. So in other words, break the contractual arrangements that have been established around those asset supply, and therefore put the organisation in jeopardy in relation to the continued capacity and access to those particular assets. By and large, it's unintentional. But if new directors come onto a board and they read a balance sheet that doesn't have administered and controlled assets delineated, then they fall into the hole of not appreciating that some assets may have those restrictions over their use and realisation, which is an important categorisation issue, so that those assets aren't misused, and more importantly, so those assets aren't sold. In Australia, there has been one program at the Commonwealth level where assets were provided by that program. I won't say which one it is, and those assets were provided on the basis that they were used for the particular service. If they were unable to be used for that particular service, they had to be handed back to the government or onto another agency. If you'd realised that asset inadvertently, you had to pay the cash back to the government for the value of that asset. So this is a really potentially significant issue in terms of the rules and regulations that are established by philanthropists or other sources of those elements. So my strong suggestion to you, if nothing else in relation to this presentation, is that you do consider splitting your controlled and administered assets for better reporting and greater understanding going forward. So understanding your balance sheet, we tend to use ratio analysis, and we have a webinar program for this particular group of webinars, this series, that's going to look much more in depth at ratio analysis going forward. I just wanted to touch on it today as part of this presentation because I think it's an important consideration in the context of both understanding your balance sheet, but also planning and building on that, financial plan that I keep forecasting I'm going to talk about. Ratio analysis is commonly used, and I'm sure people have some at least knowledge of its existence, if not practical experience of its use. But in ratio analysis, we tend to use ratios not to identify problems per se, but rather to identify areas for further interest. We don't have a lot of time, and we need to make sure that our analytical time is focused on those areas where there's real significant or likely to be real significant issues. So ratios are indicators rather than actual symptoms, if you like, of improper outcomes or problems with the organisation. Secondly, because they're only a pointer, using ratios solely for your analytical process might mean that you actually miss areas of concern. And I guess it's logical then to use as an example that issue of considering those administered assets versus controlled assets. And obviously ratio analysis still works in the context of those organisations that have that split, but doesn't necessarily give you a full picture of the organisation and areas of concern that you might think about. There are a group of commonly used ratios, and I'll speak to them and give you some examples of those shortly. And these are ratios that are globally accepted and understood in the Anglophone world. So all accountants know them and know how to apply them generally. But you might also have some ad hoc ratios that are relevant to your organisation and what you do. And being able to, I guess, apply those ratios and think about what ratios might be useful to you are really critical aspects. Again, we'll explore this a little bit more in a subsequent webinar. So decision points are also important elements where we can have ratio targets helping us to decide when to tell the board something or when not to tell the board something, or that might help us to draw a line in the sand to be able to make decisions about things like solvency or whether even we continue to provide certain services. So ratio targets are critical to be able to identify. And of course, ratios are only useful if we have a target against which to actually compare our actual ratio outcome with. So in terms of ratios, balance sheet risks and governance, I think this particular panel helps in very general terms to give you some guidance around the element that might be subject to governance and might represent a risk area for you, the risk itself, and then some governance ideas around how you might look at that particular risk. And this feeds into the next comment that I might say in relation to how the organisation undertakes its balance sheet governance as well in terms of ongoing financial planning rather than just budgeting. But you can see there, for instance, the element, the risk and the governance. The cash element is a critical element. Without cash, organisations don't survive. So the risk in relation to cash is you can't meet your outgoings in a timely fashion. You can't pay your bills when they're due, and you can't pay your employees when they're due to be paid. The governance ratio around that is a quick ratio. That is, we compare the cash and cash-like assets with cash liabilities, and we would like to see more cash assets than cash liabilities for obvious reasons. But we also use a cash flow budget to help us manage that. In other words, this panel helps us, and I'm not going to go through each element, but this panel helps us to understand what the element is, what the risk is, and what the governance framework might be. But remembering that our balance sheet governance relates to the connection between profit and loss, cash flow report, and balance sheet. We don't just look at the balance sheet by itself. We need to look at all of those reports in order to arrive at a solid appreciation of our balance sheet and the position that we find ourselves in. So come back and have a look at this. I have, as you can see in the second last line there, the Australian situation with respect to the Australian Tax Office payments to the Tax Office. But of course, you have Kiwi requirements in that respect, as well as do all countries around the world. There is a tax payment process, and you need to be considering how both you're paying or remitting your employee tax, but also what other tax implications there might be for things like VAT and so on in relation to your organisation's operations. The second element is cash, and particularly I'm keen in this slide to talk about working capital. And we look at working capital in webinar 3, I think it is, in the series very closely, but suffice to say at this point, when we think about the balance sheet, as I said before, our current assets and current liabilities are compared, and we're concerned to make sure that we've got sufficient cash to be able to pay our debt, our creditors and our employees as and when they're due to be paid. This represents the working capital chart, and the chart just simply shows you or identifies how cash is consumed in the organisation, because you provide a service, you pay staff, you might pay creditors, and then your creditors, or rather your debtors, actually pay you. Sometimes you get grant funding up front, and so the cash flow arrangements are different. But I guess at the end of the day, the working capital cycle is a really important cycle for your organisation to be able to articulate, to be able to demonstrate to your directors that in fact you've got sufficient working capital in relation to your organisation. That is, you've got sufficient money in your bank account to be able to continue to operate regardless of the situation, economically or otherwise. What does that mean in real terms? It means two things, I think. Firstly, that you need to understand working capital and how much working capital you are required to hold in order to be effective in what you're undertaking. But secondly, you need to be sure that at the end of the day, you appreciate that you can't have too much working capital, because that means that your cash is not being put to work. And so that if you have too much working capital, you need to think about whether you invest that cash elsewhere in order to generate a profit for the organisation or a return to the organisation. So understanding working capital and your cash position is both important for solvency, but also important for what we call efficiency in terms of managing your balance sheet. So we need to have some target cash levels in order to be effective governors of our organisation. And we term these reserves, and we do look at this a little bit more closely in that cash webinar. We need to be reporting outcomes in relation to cash as well. And I've mentioned before that when we talk about the balance sheet, we need to talk about it in the context of the profit and loss report and that cash flow report. Obviously, the balance sheet and the cash flow report go hand in hand. We need to think about those profitability issues. You cannot be cash effective. You can't be solvent unless you're creating a profit. In the short term, you can be in a starvation cycle and use up all your resources operating. But in terms of the medium and longer term, you're simply not going to be sustainable. So current cash flow needs relate to solvency, relate to replacing assets in the medium to longer term, and relate to investing in the organisation in that longer term as well, both related to sustainability in that broader sense of being able to provide services on a continuing basis. At the end of the day, as I mentioned right at the start of this presentation, cash is king. And the golden rule of business, the person with the gold makes the rules. You need to have those cash reserves in order to have the decision-making capacity and independence as an organisation to move forward. The other element that's really important is asset replacement. And I mentioned before that a lot of organisations in charities and not-for-profits rely on some philanthropic or other sources to replace assets, but you do need to consider this in your financial planning process. You need to think about the short, medium and longer term horizons, and that means that we need to think about where does the cash come from to replace those assets. I typically try and take a 5-year horizon for that financial planning horizon. That is looking at not just the budget for the next 12 months, but how the organisation is going to operate and fund itself for 5 years. That includes whether or not the current assets you're using are going to be useful and applicable in 5 years' time and appropriate to the services that you provide. This slide or chart shows you some of the replacement principles to help you to forecast or to foresee when assets might no longer be appropriate to your organisation. They're just suggestions about what kind of replacement principles you might take into consideration when you're looking at individual assets and determining how long they might be useful for your organisation. You need to have a look at this in terms of the risks that you're trying to avoid and what the governance response to those risks might be. So that in the first example of an asset being unserviceable, the asset can no longer be used and sustainability is negatively impacted. In other words, you can't use the asset for a particular thing. An established serviceability minimum might be related to the number of kilometres travelled by a motor vehicle, which often is taken into consideration, or the maximum age of a building, for instance. Those things are the types of things that might help you then to start to get a sense of forecasting the asset replacement requirements for your organisation. Again, I don't plan to, because of time constraints, go through each of those items, but it is worth coming back and just having a look at those in the context of forecasting your asset replacement needs going forward. Finally, cash flow budgeting and financial planning. Budgeting, I think, is well established in not-for-profits and charities in the Anglophone world. So pretty much everywhere I go, organisations are quite used to and competent at building their budgets. But budgets are really only looking at financial planning for 12 months, not for the extended period beyond that 12 months. And a financial plan, I think, is a most critical element for governance for organisations going forward. As organisations become under greater financial pressure, and I think it's the case in New Zealand as it is in Australia, then that financial plan becomes incredibly important to foresee issues that are going to impact the organisation, not only in relation to the balance sheet, but more formally over the next 3 to 5 years. So financial planning is important, but I think it's much, much less likely that not-for-profits and charities are actually undertaking this process than they are undertaking budgets. I mentioned before that 3 to 5 year horizon is absolutely critical. Of course, the lower the horizon, the more likely you're going to be effective and accurate in terms of your planning. But the longer term the horizon, the more likely you're going to pick up potential issues down the track. And then, I guess, components of financial plans, just to give us a little bit of an idea of those elements that you need to take into consideration, in my view. Annual development means that we're looking at the annual operating budget, cash flow budget, and capital budget. So the typical budgeting process informs the financial plan going forward. And you still need to have that budget process, of course, to confirm what it is you're going to do and how you're going to do it. The ongoing development, though, includes documents like the asset reinvestment plan, and that previous panel helps you to understand that asset reinvestment plan. What assets are going to turn over? When are they going to need replacement? What are they likely to cost? And where are you going to get funds for to be able to manage that? The employee entitlement payments estimate is also important. So based on your experience, when do people take leave and how much is that likely to cost at some future point in time? So we don't just want to know what the cost of employee entitlements or the value are of them today. We need to know what their value is in the longer term. And then those governance questions under each of those elements all lead to us arriving at the annually updated financial plan for the organisation. So what does our 3 to 5 year outlook look like? And of course, that financial plan then informs the budget going forward as well. So it's a cyclical process where we develop the financial plan annually or revisit the financial plan annually as we develop our annual budget. Okay, I've spoken very, very quickly to get through a lot of material, but I also, as I mentioned before, wanted to make sure we had 15 or 10 minutes to be able to respond to questions. I think we've landed right in the middle with 13 minutes available to us for the hour. Natalie, any questions come up on chat?
Well, thank you very much, David, first of all, and great presentation, very good timekeeping. I haven't seen any questions in the chat, but perhaps people are reflecting at the moment and have got some questions coming up. As David mentioned, we still have a few minutes, so by all means, either use the chat or if you'd like to unmute yourself, because we are in a smaller group than anticipated.
I'm also really happy to receive emails outside of session if that helps as well, of course.
Great, thank you. Would anyone like to unmute themselves? And I guess you've been very clear, David.
I hope so. I hope that's what it means. There's one of two ways, one of two meanings.
Yes.
Hi, Natalie. Hi, David.
Hi, Kylie.
Yeah, I've got an interesting question about, so being in a not-for-profit space, how do we mitigate risk against our leave entitlements if they're long, like there's been a long-term build-up of leave entitlements or cash that needs to be attributed to it? How do you mitigate that, or how do you get out from that?
So there's a couple of caveats to my response, I guess. Number one is what the industrial situation for your organisation and the industrial legislative framework and that you're working in obviously has an impact in relation to that, in the context of the extent to which you can direct people to take leave and how you might arrange that. So, for instance, it's not uncommon in Australia for where people build up significant amounts of annual leave, for instance, that you direct them to take a day a week or a day a month or to take leave over Christmas or have a Christmas shutdown or whatever that happens to be. So in other words, managing that leave to extinguish it over time. If the person has accrued a lot of leave, so a number of years worth of leave, then that will be expensive as well, as you're no doubt aware, because of course they accrued much of that leave on lesser pay rates in history. And so having the option of being able to pay out in iterative instalments over time is a really important consideration from a cash flow and solvency perspective. The other thing that happens in the Australian context, and I apologise, I'm not sure whether this is something that happens in the New Zealand context, is that people might also negotiate to be paid out their leave. And the logic of that is that, of course, in an occ health and safety sense, it's important that people take leave and get a break and so on. We understand that. But if you've got excessive leave, then it might be both impractical and from an occ health and safety perspective, less important that all of that leave be taken. So one of the options that is often exercised in the Australian context, as I say, is that people actually buy out their leave or sell their leave to the organisation. They get a cash payment for that to extinguish that debt. Now, that can be difficult from a solvency perspective, but recognising too that as time progresses, if that leave balance stays there, it's likely to becoming increasingly expensive for the organisation to meet as well. So there's an opportunity cost to consider there.
Thank you. That helps. Thank you.
Right.
Right. Thanks, Kylie, for your question. We did also receive another question on the chat here. Is it wise to keep a separate capital budget for organisation, like 2 to 5 year one, or should it come out of the reserves?
I think there's two things. The financial plan should have a capital budget component in it. So you should have a capital budget developed annually in terms of the capital that you need to spend, which is the realisation of projects that have been in the pipeline for some time. The financial plan itself incorporates a cash flow. It should incorporate a 3 to 5 year cash flow plan that's going to incorporate those asset replacement requirements as well. Remembering that you might have a worst case scenario financial plan where everybody has to undertake and provide for their own replacement of assets. But as the timing gets closer, as the replacement time of that asset creeps closer, it could be that you start to have discussions with philanthropists, you start to let them know what your requirements are and so on. So the financial plan doesn't just relate to the question of how much cash do we need and when are we going to replace the asset, but it also helps you to develop your strategy in terms of managing philanthropists and others that might be relevant to your organisation and making sure they understand what you need when they need it. And perhaps sometimes it's easier for them to plan 2 years in advance rather than trying to sit through all of the calls on their money today, if that makes sense.
It makes sense to me. I hope it also makes sense to Jaspreet, who asked the question. Would anyone else like to use the opportunity? Thanks, David, Jaspreet says. No, no one? Great. Well, I think we'll close the session then today. Thank you very much, David, again for your time and for your knowledge, for sharing it with us, especially here in New Zealand. We much appreciated that you've made the time to join us today. And as mentioned, we'll send out slides afterwards, and we hope to see you next month. And I'll obviously send out a reminder closer to the time.